Indonesia is a major player in global trade, boasting some of the largest international trading schemes worldwide. Its export of palm oil alone generates billions of dollars, and with increasing foreign investment in the country's electric vehicle industry, Indonesia's economy is rapidly evolving. This growth in exports and foreign investments has led to a surge in foreign reserves, which consist of foreign currencies primarily denominated in US dollars. These reserves have been instrumental in ensuring the stability of Indonesia's economy, currently standing at $145 billion, the third largest in Southeast Asia, trailing only Thailand and Singapore. The crucial question, however, is whether these foreign reserves are truly significant. This video will explore this topic in depth. To understand why Indonesia's foreign reserves are big, we first need to examine the country's balance of payments. The balance of payments is basically the record of a country's economic transactions with the rest of the world. It includes trade in goods and services, income received from abroad, and capital flows. A positive balance of payments means that a country is earning more foreign currency than it is spending, while a negative balance of payments means that a country is spending more foreign currency than it is earning. Indonesia's balance of payments has been positive in recent years, thanks to its strong export performance. Indonesia is the world's largest producer of palm oil, the second largest producer of cocoa, and a major producer of other agricultural commodities. It is also a significant exporter of mineral products such as coal, nickel, and gold. Data from the World Bank in 2021 shows that Indonesia's exports of goods and services amounted to a whopping $246 billion, while imports amounted to $217 billion, resulting in a trade surplus of $29 billion. This positive trade balance has contributed to Indonesia's large foreign reserves. When a country exports more than it imports, it earns foreign currency, which can be used to buy assets denominated in other currencies, such as US dollars, euros, or yen. These assets, known as foreign reserves, provide a buffer against economic shocks and can be used to pay for imports or service foreign debt. In addition to its strong export performance, Indonesia has also received significant inflows of foreign capital in recent years. Foreign investors have been attracted to Indonesia's growing economy, large population, and abundant natural resources. According to the Bank of Indonesia, foreign direct investment in Indonesia reached $22.9 billion US in 2020, while portfolio investment amounted to $15.3 billion US. These inflows of foreign capital have boosted Indonesia's foreign reserves, allowing the country to maintain its economic stability and weather external shocks. However, Indonesia's large foreign reserves also pose some challenges. One concern is that they may discourage investment in the domestic economy, as investors may prefer to hold assets denominated in foreign currencies rather than in rupiah. This can lead to a Dutch disease effect, where a country's strong export performance leads to an appreciation of its currency, making its other exports less competitive. To address this concern, the Bank of Indonesia has implemented measures to manage the exchange rate and promote domestic investment. Furthermore, it is also worth noting that while Indonesia's strong export performance has contributed to its large foreign reserves, it has also been a source of vulnerability in the past. Indonesia's economy is heavily dependent on commodity exports, which are subject to price volatility in the international market. For example, in 2014, the collapse in global oil prices caused Indonesia's current account deficit to widen, leading to a sharp depreciation of the rupiah and a decline in foreign reserves. To address this vulnerability, Indonesia has embarked on a program of economic diversification, with a focus on developing its manufacturing and service sectors. The government has implemented policies to promote investment in these sectors, including tax incentives, streamlined regulations, and investment facilitation services. Indonesia's efforts have started to pay off, with the manufacturing sector accounting for a larger share of the country's GDP in recent years. Finally, the last factor contributing to Indonesia's large foreign reserves is its policies on fiscal and monetary management. The government has implemented prudent fiscal policies to maintain a balanced budget and reduce its debt-to-GDP ratio. Meanwhile, the central bank has pursued a policy of inflation targeting, which has helped to anchor inflation expectations and maintain the stability of the rupiah. These policies have helped to build investor confidence in Indonesia and attract foreign investment. Now, aside from Indonesia's foreign reserve accumulation, let us dive into the understanding of risks involved with either having too low or even too high of a reserve. A country with low foreign reserves may be vulnerable to external shocks, such as sudden decline in exports or capital outflows, which can lead to a currency crisis or balance of payments crisis. This occurred several times around the world and was also the cause for one of Indonesia's biggest crises ever. The Asian financial crisis of 1997 hit Indonesia hard, with the country experiencing a sharp devaluation of its currency, the rupiah, and a deep recession. At the time, Indonesia's foreign reserves were only around $18 billion US, which was not sufficient to buffer against the external shocks caused by the crisis. The country was forced to turn to the International Monetary Fund for a bailout, which came with strict conditions including austerity measures and economic reforms. On the other hand, a country with excessively high foreign reserves may face challenges such as low returns on investment, exchange rate management difficulties, and disincentives for domestic investment. In the case of Indonesia, while the country has benefited from having a large foreign reserve, there are political risks associated with maintaining such a high level. One risk is the possibility of currency appreciation, which can make exports less competitive and reduce the country's export revenue. This can also lead to a decline in the manufacturing sector, which may result in a loss of jobs and reduced economic growth. Another potential risk is the temptation to use foreign reserves to finance budget deficits or other short-term needs, rather than maintaining them as a buffer against external shocks. This can lead to a depletion of reserves and leave the country vulnerable to future crises. However, having a large foreign reserve also comes with several advantages. It can help a country to maintain its creditworthiness and attract foreign investment, as investors may feel more secure knowing that the country has a buffer against external shocks. Foreign reserves can also be used to pay for imports or service foreign debt, which can help to maintain a stable balance of payments and avoid currency crises. To properly understand just how big Indonesia's foreign reserve is, we can take a few selective indicators from the World Bank. One of them is total reserves in months of imports, which basically means how much time a country's total reserves can cover for its imports. As of 2021, Indonesia's total reserve in months of imports is about 7 months, which is higher than the average of between 3 to 6 months, according to the IMF. Secondly, another indicator is total reserves as a percentage of external debt, which means that it measures the capacity of a country to meet its external debt obligations using its foreign reserves. In 2021, it is about 34.8%, which is a figure that is quite below the world average. In conclusion, Indonesia's large foreign reserves are a result of its strong export performance and inflows of foreign capital. These reserves have played a critical role in maintaining the country's economic stability and allowing it to weather external shocks. However, they also pose some challenges such as the risk of a Dutch disease effect and a potential disincentive for domestic investment. Going forward, Indonesia will need to continue to balance its export performance with its domestic investment needs. This will require ongoing investment in infrastructure, education, and other areas to support economic growth and diversification. It will also require careful management of the exchange rate and foreign reserves to ensure that they continue to support Indonesia's economic stability without hindering its domestic investment and manufacturing sector. Additionally, Indonesia will need to remain vigilant in addressing the vulnerability of its commodity-dependent economy, which can be subject to price volatility in the international market. The government's efforts to diversify the economy and promote investment in the manufacturing and services sectors will be key in reducing the vulnerability and ensuring long-term economic growth. Overall, Indonesia's large foreign reserves are a double-edged sword, providing a buffer against external shocks and supporting investor confidence, while also posing challenges and risks. By carefully managing its reserves and continuing to invest in its economy, Indonesia can maintain a position as a key player in the global economy and ensure sustainable economic growth for years to come.